Hello, I'm Tim Gaumer. My team here at Thomson Reuters is working to find new ways for you to make money as you trade and invest around the world. We'll do that in this video by showing you how we evaluate earnings quality using our premium StarMine content. Today we offer this within our Thomson One product suite. I'll be using Thomson One Investment Analyst. We'll use Wynn Resorts in our example. Our model scores companies on a 1 to 100 basis. 1 is the most bearish, 100 the most bullish. It's a relative percentile ranking of all companies in a region. At a rank of 99, Wynn ranks in the top 2% within North America. Pretty hard to beat. Next, we break this page into 4 components: accruals, cash flow, operating efficiency, and exclusions. Let me explain our model. Based on our quantitative research, we're focusing on the various sources of earnings. Some are more sustainable than others. Your opportunity as an investor is that the market is inefficient at separating sustainable from unsustainable sources of earnings. A dollar is a dollar. Our research shows that earnings backed by underlying cash flows are more sustainable than earnings from non-cash sources. Free cash flow generation is measured by our cash flow component. More free cash flow results in a higher number. The green portion of these bars shows the amount by which free cash flow exceeds net income. Cash flows are at an all-time high here. Accruals are the opposite. They're the non-cash source of income. Since accruals tend to reverse fairly quickly, they're considered an unsustainable source of earnings. High accruals are bad for the model score. As you can see, there's no problem here. We also measure operating efficiency. How efficient is the company in generating returns? We break this down into operating profit margin and asset turnover. Of the two, asset turnover is more sustainable. If you click the chart icon, you can see why operating efficiency for Wynn greatly improved through the June quarter. Finally, for companies in North America, we'll compare GAAP earnings to pro forma earnings, a non-GAAP number that some companies prefer to highlight in earnings news releases. But over time, GAAP matters. This component of the model we call exclusions. A couple years ago, Wynn was investing heavily in new casinos in Asia. StarMine's EQ score shows that the investment appears to be paying off handsomely. Now, let's look at CarMax, which operates a chain of used car dealerships. You'll see by the StarMine EQ score that the jury is still out on this one. CapEx exceeds net income in most quarters. In many quarters, the company's expansion plans are not self-funded through internal cash flow generation. As I mentioned earlier, it's helpful to consider whether a company is earning an adequate return on its investment. Notice that at 20, operating efficiency receives the lowest component score. CarMax has a relatively low pre-tax return on net operating assets of 6.5%, which is well below the industry median, and consistently so. This trend goes back to 2001. The disparity within the industry widened last year. So CarMax may not be generating an adequate return on the capital it's using to grow. When I worked as an analyst, the charts I've just shown you used to take me far too long to build in Excel. And beyond that, our stock selection models, like the earnings quality one I just showed you, are developed to help you generate alpha. For a trial, please email us at im_info@thomsonreuters.com. I'm Tim Gaumer. Thanks for watching.